Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates and 10-year note yields on 9 months highs, but stalling a bit. So we got to 2.5% yield. We did see yields creep a little bit lower today, but we remain outside of that old 230 to 240 range. So the market is definitely making a shift here. It's been unable to extend that, but that's not a bad thing here. We can kind of consolidate this level and then reassess. But right now we are outside the old range. The market has seen some aggressive selling, at least not only before the tax reform went through, but after as well. And it looks to me like we've got the bond market's setting up for a 2018 of higher yields, which will all start with the Fed when they continue to raise rates, hopefully, in the spring of 2018. And if you can imagine what happens when you break out of a range, you break out the trend, then you start to see volatility bit, and we did just that. Volatility's been trending higher. We're seeing levels that we haven't seen since the first week of December, which is pretty good since considering we've been trending lower really since early November when Powell was nominated as the Fed chair. So right now, volatility trending higher. We're outside the range. But hold on, things could slow down. We have positioning numbers that came out last week that suggested that leverage funds are very short. In fact, the shortest they've been in over a year. So right now, that any short covering into year end could put a halt to the yield rally we're seeing and see prices kind of reascend. So right now, I'm skeptical of seeing a big move higher in yields ahead of the year end. Leverage funds could be in buying, looking just to cover, and then we'll reassess after the first year. So right now, still seeing we're seeing a breakout in 10-year yields above the old range, but looks like we're going to hold there until year end. This is Todd Colvin coming to you from the floor of the CME Group.